Hello and welcome to our Moss Adams webcast, R&D Tax Credits for Technology Companies. I'm John Murphy, a tax partner based in Silicon Valley. I will be your moderator for today's webcast. Our presentation will start in a few minutes. Before we begin, a few housekeeping items. Today's session will offer you one CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. To respond to the poll, simply click the radio button next to your answer and click on the Submit button. You can track your CPE progress by clicking the CPE Progress button at the bottom of the webcast console. The button looks like a teacher with students. Once all certification requirements have been met, a download icon will appear in the bottom right-hand corner of the CPE Progress window, and you will then be able to download a copy of your CPE certificate. You can do this at the end of the webcast or log back in later. You may ask our presenters questions during the webcast by using the Q&A feature. In the bottom left hand of the webcast console, you'll see the Q&A box. Just type in your question and click on Submit. We will do our best to answer all questions, but if time runs short, we will follow up after the webcast. We also have handouts. That's the button at the bottom that looks like a file folder. This area includes our slides and helpful links. As a reminder, the presentation you're about to see is not legal or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. Let me introduce today's presenters. Tom Sanger leads Moss Adams' R&D Tax Services practice, overseeing all research tax credit projects. He performs studies for companies in many industries, including technology, medical devices, and pharmaceuticals. Tom also has extensive experience successfully defending companies during federal IRS and state examinations. Joining Tom today is Travis Riley. Travis provides research tax credit studies for middle market companies in various industries. He has extensive training in tax law research related to the research tax credit and can apply it to various industries including software services and medical devices. Travis is an enrolled agent licensed to represent taxpayers before the IRS. On today's webcast, we'll cover a number of topics. First, we'll get through an understanding of the benefits of the credit. Then we'll get into the federal R&D credit qualifications, and then drill down to some technology-specific opportunities and issues. We'll also address the IRS and state exam issues, recent developments, and then some next steps and key takeaways. We know that we have people on the line with various levels of experience with the R&D credit. So to get everyone on the same page, we'll start out by having Tom provide some background on the credit. Tom, take it away.
Thanks, John. Before we get into the details, I will first go over the status of the credit. The United States was one of the first countries to have a federal R&D tax credit, and the credit's been around for about 33 years. It was created to spark innovation as it was deemed that we were falling behind Japan, Europe, and other countries in our innovation initiatives. Since then, most countries have an R&D tax credit, and many are more lucrative than our credit. This past year, there has been significant discussions about making the credit more lucrative, but those have stalled out. Yesterday, the House voted 378 to 46 to retroactively extend the credit, basically in the same form that it's been in the last few years, basically from January 1st to December 31st, 2014. In the last one or two extensions, it was retroactive 1 year and then forward 1 year. So this is a little different in that it's only for 2014. And so we'll be back to the same area where we don't have a credit in 2015 if the House bill passes through the Senate for signature. And it appears that the Senate is planning on voting on it next week, and the Obama administration has stated that they will not oppose the 1 year or the 2014 extension. So for financial statements for the fourth quarter, you should most likely be recording all of your credits for the 2014 year, all those ones that weren't allowed to be recorded because there was no credit for 2014. And then we will be basically back to where we started with no credit for 2015. So the credit does get bipartisan support for both houses, Obama's administration, and others. So a couple of good resources for everybody to have if they want to know kind of the status of what's going on is, one, the Moss Adams, we have a R&D tax credit forum on LinkedIn. It's an open group, and we try to put the various legislation and what's going on with tax court cases and things of that nature. So highly recommend people go there to get some information. The other area on the lobbying side of things, the National Association of Manufacturers has an R&D coalition that does a great job at educating and lobbying for the tax credit. And so typically they're having weekly status calls. They've been doing that for the last few months as they're trying to get this credit extended. They're also more than willing, or they are very happy to have your participation in contacting legislators and obviously helping out in the lobbying effort as well. So as you're thinking through the R&D tax credit and the importance to your organization, they are a great organization, and we've included Christina's contact information for McNam. So the federal R&D credit, why is it important to everybody? It's a very significant credit. It's probably the most significant corporate credit out there at this point. It exceeds billions of dollars every year. There's significant tax savings. It's basically rewarding you for designing and developing new products and processes. So it's very relevant to many, many industries, as well as obviously the tech industry. Roughly, the math is out there, but it's somewhere around the 6.5% range is what your net credit is of qualified research expenditures. And then as it states, there's many states also have lucrative credit. So it's on the federal side of things and on the state side of things, it's a very lucrative credit. As I mentioned, state credits, over 35 states have some form of a research credit. Most follow the federal definition with a couple changes. One, the research must occur in the state that you're doing it. For the federal credit, it has to occur in the United States. Two, gross receipt definitions are defined state by state. And then there's different carryback rules for each state. So federal is about 20-year carryback. The various other states, they differ from state to state. And there's alternative simplified credits out there and other things. There's a few states that have a permanent credit, California, Massachusetts, and a few others, I believe, as well. But many have credits that are longer term than expiring every 2 years. So definitely the state side of thing is probably more stable than the federal. And in some cases, with the right fact pattern, state credits can be more lucrative than the federal credit. Arizona has a great credit, and it's also refundable. So very significant for the tech companies out there in the fact that even if you aren't able to utilize the credits immediately for federal purposes, for state, you can get some dollars sent back as a refundable credit. The California credit, they follow the federal definition of qualified research with some exceptions. Again, like most states, the R&D has to occur in the state of California, and then their definition of gross receipts is gross receipts occurring in California only. So big areas there. Open tax years, generally 4 years. Typically, federal is 3 years, but if you've been in losses or AMT situations for federal and other states, potentially you can go back more than the 3 or 4 year time period. The other big area for California is it carries forward indefinitely. Special rules for S corps is it's a 2-level of credit. You get a third of the credit at the S corp level, and then you get the full credit passed through to the shareholders as well. So in that case, it's a very good credit. Here's a list of the various credits or the states that offer a credit. And as you can see, some of the big states that we kind of mentioned, Arizona, it's refundable. It's a 15-year carried forward. We also have Oregon, which is a unique one in that for LLCs, they currently are not allowed to claim the credit. Moss Adams is currently working with drafting some legislative changes, so that way, one, it'll be for LLCs as well as trying to make it more lucrative. We'll see where that goes. And then Washington State has a high technology B&O credit for R&D spending, as they do not have an income tax credit. So there are many states have them. As mentioned, they mostly follow the federal rules with some different changes on each one. But for the most part, these are the states that have some sort of an R&D tax credit. This slide here just kind of it's something out there just to kind of show you kind of the potential for benefits. And these are all hypothetical, and they're not necessarily exact, but it basically shows that different size companies can get credits, and these are on the annual basis. And it doesn't. One big area to really understand is it's not a revenue-based credit. It's a qualified research expenditure base. So even if you have companies that are very small revenue because maybe you're not fully productive, but you have a lot of QREs, you can have a very significant credit. And typically when we're doing studies, we're doing companies for one or more years, and it's not unusual to be getting credits in excess of hundreds of thousands of dollars, and some of the bigger ones we do are probably in the $10 million range. So the credits can be very significant. It's also based on the size of the company and the amount of qualified research expenditures that a company's doing. But the point is, it's a very lucrative credit on both the federal and a state credit basis. So, every company out there probably who is designing or developing new products or processes should be looking into it. So before we get too far into a project, we always want to get an understanding of when these credits can be used and any kind of limitations that are out there. And the credit, for the most part, for the federal as well as most states, it's not a refundable credit. You have to be paying taxes to utilize this. And so in a lot of cases, the first thing we're doing is we're trying to figure out when will these credits be utilized. And big areas, just tax liability limitations, if there's been change of ownership, the 382, 383 considerations, AMT, carry forward provisions, things of that nature. Other area just relates to understanding, the IRS and state scrutiny on originally filed returns or amended. Neither one is something that should stop us from claiming the credit, but just understanding what that means and how it's going to be affected. And then another big area just is understanding the funding and the risk and rights. So one of the big areas Travis will probably go into a little later is just the need for risk and rights for R&D. Other area just relates to time and resource commitments, both on your CPA provider or internally. And it's just an area where you're looking at cost benefit for the taxpayer and understanding really what it's going to take to do this. So next up, John has our first polling question.
Okay, great. Time for the first polling question. This will give us a little demographic information. Which of the following applies to your company? My company's never claimed the credit. We've claimed the credit, but have done minimal work to substantiate the amounts that we've claimed. Or my company claims a robust credit that's thoroughly documented, and I'm just here for the CPE credit. So make your selection by clicking on the radio button, and then be sure to click on Submit. And we'll give you a few seconds to get that done. Okay, has everybody had a chance to put in their response? Let's see what the results are. All right, quite a few companies that have never claimed the credit, and those that have are sort of split between the ones with good documentation and the ones without. So, Travis, any comments on that?
Yeah, it's really helpful to know as we start digging into the various rules surrounding the research and development tax credit, and describing what qualifies and what types of expenses can be included. I think it's going to be helpful for a lot of the audience.
Okay, great.
So,
go ahead, Travis.
It's going to lead right into our next discussion here on what qualifies for the R&D tax credit. So the R&D credit is an activities-based credit. Basically, your activities have to meet a 4-part test that's outlined in the tax code. It has to meet all 4 of these tests. And we're going to go through each one of those individually. So the first requirement is that there's some level of technical uncertainty at the onset of a project. So uncertainty regarding the capability, method, or the appropriate design of a new or improved product, process, or software. And so if it's something that you've never done before, or something you're doing for the first time, maybe a new application, and you're asking yourselves, can we do this, or how are we going to do it? Or maybe you know how you're going to do it, but you're asking yourself, how do we get from point A to point B? When you're asking those types of questions, you're going to meet that uncertainty requirement. So next up is the process of experimentation requirement. The way this is defined in the tax code is really just evaluating alternatives to eliminate those unknowns that you have in the beginning. And some common examples that are provided in the regulations are things like modeling, simulation, trial and error activities. And so, if you're a software developer and you're writing code and testing code and then making revisions to the code based on the test results, what you're doing really follows that iterative process of experimentation that they're looking for here. Also, if your company is building and testing prototypes and revising prototypes based on test results, all of those activities fit within the process of experimentation. So those first two tests that we talk about are usually the most challenging to meet and to document. This third test here, the technological in nature requirement, what that says is that the activity has to rely on the hard sciences, like computer science, like engineering, as opposed to soft sciences. So things that would not be technological in nature are things like market research or managerial studies, those types of things. And then the last test here is the qualified purpose test. If you are developing new features, functionality, if you're making improvements to a product that results in better quality, performance, reliability, those types of things, then you're going to meet this qualified purpose requirement. Things that would not qualify here are things like changing the look and feel of something. Those wouldn't necessarily meet the qualified purpose test. So once we've determined that your activities meet all four of those requirements, there are three categories related to those of expenses related to those activities that can qualify for the tax credit. And we're going to go through each one of those individually. So first up is people's wages. So that includes people who are performing the research, who are doing the experimentation we talked about, as well as anybody who is directly supervising or directly supporting those activities. And so, if you have a second level supervisor, like say a CTO who's two levels removed, it might be a little more challenging to include the wages of that person. Also, you see here what they call a substantially all test. What that means is that if an employee is engaged in qualified research at least 80% of the time, then you can include 100% of their Box 1 W-2 wages in the credit calculation. And for a lot of tech companies, the wages are really the key driver of the R&D credit. The next category is qualified supplies. So for supplies to be included, it cannot be depreciable property. This is usually consumable, tangible materials, or prototype costs, things of that nature. Things that we cannot include are general and administrative supplies, office supplies, computer software that you've purchased, things like that we cannot include as a supply.
So Travis, would the cost of computers qualify?
That's a good question. So if you're purchasing a computer, that is considered depreciable property, and you would not be able to include the computer as a supply. However, there is a provision in the tax code that allows taxpayers to include the rental costs of servers. So if you're renting servers and those servers are completely dedicated to your research and development activities, then you can include those server rental expenses. So the third category here is contract research. So if you're paying any other third party, whether it's a company or an individual, to perform qualified research, maybe they're doing engineering type activities, or they're working in a consulting role, or they're performing testing on some of your new products. Now, payments to those contractors could be included in the qualified research expense calculation. And so, one of the key requirements here, it lists a couple, but what this really means is that your company has to retain rights to the intellectual property that's being developed by your subcontractors.
Kevin, what about the location of the contractors?
Great point here. So a lot of the tech companies that we talk to, they hire a lot of engineering consultants and individuals outside the United States. So those expenses cannot be included. The research has to be performed in the United States. So, let's say your company hires an engineering firm in India to perform a bunch of R&D. So the time that they spend outside the United States does not qualify. However, if those individuals are traveling to your office here in the United States and working alongside your employees, then a portion of their time could be included.
Okay, it's time for the next polling question. See how well we understand these qualifications. Which of the following expenses are eligible for the R&D credit? Amounts paid to contractors who perform work outside the U.S., wages paid to second-level supervisors in an R&D department, patent-related attorney's fees, or all Form W-2 Box 1 wages paid to employees who conduct qualified research at least 80% of the time. So click on your selection by hitting the radio button, and then be sure to also click on Submit. And remember, you need to answer these questions in order to get your CPE credit. Okay. Let's see what we have for results. I think that they're paying attention, Travis. Looks like almost everyone's got the D selection there.
All right, thanks for paying attention. Before we move on to the next slide, there was one question that came in about, can you include the cost of laptop rentals as a qualified research expense? And, I think the answer there is that you possibly could include those expenses. There is a provision in the code that says, the cost of computer rentals could be an eligible R&D expense. So if you can show that your engineers are using those laptops to perform qualified research, it's possible that we may be able to include those expenses.
Thanks, Travis. That was a great overview of the qualifications. Now let's drill down and see what opportunities are specific to the tech industry. Tom?
Wonderful. Well, as Travis mentioned, the requirements for activities to qualify often open up a number of industries to qualify. So, we see it in manufacturing, construction, we see it all across the board. When we're dealing with technology companies, all tend to have some R&D. The question is how much and what to capture. Other big area just relates to, as Travis mentioned, the understanding of the risks and rights. And so big area relates to, does the company still have rights to the technology, and or did they retain the risk? So kind of a deeper dive into it, but for the most part, all technology companies are doing R&D qualified activities. These are some of the standard technology companies that we deal with on a regular basis, and again, it's one where if you're designing or developing new products or processes, most likely you're going to qualify. Some technology-specific opportunities: software, coding, development. Software that's embedded in hardware is a big one. Internal use software, very contentious area. Meet the high threshold of innovation test, which is basically, as Travis mentioned, those 4-part tests. But on top of that, you need to throw in the three-part high threshold of innovation tests. And the first one is it needs to be innovative. So if the software is unique or novel. The second one is significant economic risk. this is not clearly defined, but significant dollars need to be at risk, and it relates to the specific company. So what significant economic risk is for one company might be completely different for the other. And then the big one, just not commercially available, so it cannot be purchased, leased, or licensed outside there. Travis will be talking about the court cases and audit guide related to this a little later, but which provides a lot of guidance on the rules. Some potentially qualified activities for software, coding for new software architecture or algorithms, functional enhancements for existing applications, intranet software, which its scale and complexity creates a lot of technological challenges. Just overall, all the things that our companies are doing pretty much have some components of it that do qualify. And so as we keep seeing the innovations that's occurring in the software realm, we're capturing lots of credits in this area. So basically anything that meets the 4-part test, and if it's internal use, the 3-part test as well. So documentation requirements. So this becomes a big one. In many cases, the credit usability limits companies from investing in documenting and supporting the credits being claimed. So basically, if companies aren't able to get any immediate benefit for it, they have challenges to basically say, how much are we going to really invest in documenting it? And I understand that, but some of the areas and some of the potential for just maybe doing some amounts, even in the early stages of your company, relate to the ability to, after the fact, come back and document some of this stuff. A big one is just to substantiate the amount. How do we come up with, what qualified expenses should we be capturing, how they relate or how they connect with the qualified activities. And so that's the nexus between the amount and the activities is saying these people were working on this qualified activity, and being able to connect those two is very, very important. And then obviously the big area is just identify and demonstrate the qualified nature of the activities, basically documenting the 4-part test as well as potentially the 3-part test for internal use softwares. Big common issues for tech companies is just the availability of people and financial records for base years. So we didn't really go into the math on the credit, but there is some requirements to be documenting the early years, and that's for the credits that are being carried forward, but also for the calculation of the credits on a go-forward basis. And one of the big areas just relates to having the documentation and having access to people that really do know what was occurring in prior years. The other big areas just relate to no project or timekeeping records. This is not something that should eliminate the credit being captured, but the more detailed or the more support we have for the documentation of time and time track to projects, the better off we're going to be. For FIN 48 or tax prep requirements might justify or require a certain level of support for the R&D credits being claimed. So as we're thinking through it, as the dollars become bigger for both the tax records as well as for the financial statement, it might just justify more documentation, more support for the credits being claimed.
Tom, is this something that we could help our clients with, getting their documentation in order, or figuring out a system on an ongoing basis?
Yeah, we do that quite often. I mean, one area we do is we do a full study where we go back and we capture all the credits. We get the documentation in place. We create systems of how to capture information so we have all the information in the future. In other cases, we come out and do some consulting on just saying, here's what you have in place and here's what you need to retain for the future. And a big area that we see is people kind of forget about all the failed projects. And for R&D, a failed project is a great example that there were uncertainty involved, whether it's technological or other. And so it's one where we want to be capturing those as well. And in some cases, we're dealing with credits that were generated many, many years ago. The credit does carry forward for 20 years. So in some cases, we have to be supporting a credit from 20 years ago. And if clients are supporting or are purging their information for whatever reason, we're losing all that support, which means the credit is probably going to zero. So it's one where just educating folks and getting that documentation in place is really important, especially with turnover and other things.
Okay, great. Well, it's time for another polling question. This looks like another demographic question here. My company's in the following industry: software, hardware, clean technology, biotech, life sciences, manufacturing, or other. So take a moment to make your selection. Be sure to click the submit button. I'll give you another second or two. Okay. Let's see what kind of a group we have. Looks like a little more software, hardware. It's the predominant one, but we've got people in all kinds of different groups. So something that's always an area of concern is how the IRS and the states are going to be treating the R&D credit upon exam. So we'll have Travis take us through that. Travis?
Sure, thanks. So IRS and state examinations, we want to talk about some of our recent exam experience. So the R&D credits are very heavily scrutinized tax credit. As Tom mentioned earlier, it's one of the more lucrative credits, so it's really on the IRS's radar. Up until a couple of years ago, it was treated as a Tier 1 initiative, and that meant that any time a corporation amended their tax return to claim R&D credits, it was an automatic audit. Now, it's no longer a Tier 1 issue, so the examinations aren't automatic, but it's still a very heavily scrutinized credit at the IRS and the state level. And so I think here, just giving you a few key areas that examination teams are likely to focus on when they do examine R&D credits. The fixed base percentage substantiation, so the credit, I don't know how much we got into this earlier, but the credit is a credit for increasing research activities over time. So that means you have to look back at some of your historical R&D spending to calculate a base amount that your current R&D spending has to exceed. And so that's what this fixed base percentage refers to. Now, it's a really easy area for the IRS and state authorities to pick on because a lot of companies don't have great documentation in some of the earlier years, especially if you're a startup company. A lot of times you're just, doing work to survive and you're not really, focused on documenting R&D credits. So easy area for them to look at. And that really leads into the next bullet point here too, documentation. Now that's another area that the IRS is always requesting information for. Now, how are you documenting that you engaged in a process of experimentation? Show us documentation to prove that there were technical uncertainties, those types of things. And a lot of the R&D credit claims rely on estimates, which is okay and allowed by law. However, it's also another area that the IRS scrutinizes. If we are relying on estimates, what types of documentation is available to prove that those estimates are accurate? So then just a few other areas, when you hear the term nexus, you'll hear that a lot when you hear about R&D credits. What that means is, IRS wants to see how your R&D expenses are tied directly to your R&D projects. So there is no requirement that you have project accounting in place, so you don't have to track expenses to projects. A lot of times taxpayers will rely on estimates to make that determination, or we come in and help to determine those allocations. But it's an area that the IRS really wants to see, and the FTB and the other state authorities. And part of the reason for that is, if they're looking at 10 different projects to see if they qualify, and they determine that one of those projects doesn't qualify, then they want to know how they're going to carve it out. So part of it's, just from an accounting standpoint. The other area that receives some scrutiny is job titles. And so as I talked about a little bit earlier, you can include direct supervisors. And so if somebody like a CTO, is heavily involved and hands-on and directly supervising qualified research, they may receive more scrutiny just because of their job title. It appears that they could be more of a second-level supervisor. And then I threw in a bullet point here on California FTB exams. So California probably scrutinizes the R&D credits more than any other state. However, if you get audited by the IRS and there's a good result, the FTB will follow the federal outcome.
So Travis, is this credit worth it?
That's a good question. After going through all that, I think so. Let's say, if your company has, let's say, $1 million in engineering payroll, and you're located in California, that's over $100,000 in R&D credits for every year that you're looking at. And although these do receive a lot of scrutiny, we usually are fairly successful at the field examination level. For those that aren't successful at the field level, we have taken up to appeals, all the way up to the appeals level, and gotten some pretty good answers there. I mean, there's never any guarantees, but based on our experience in working with these, the process could take a couple years to get a resolution. But I don't think we've ever had a client come back and say, no, that wasn't worth it. So I think the cost benefit is always there.
Okay, let's go to our next polling question and see what the audience's experience has been in dealing with IRS exams. So my company's been selected for IRS exam, the R&D credit. You get to answer yes, no, or not applicable because we don't currently claim the R&D credit. So click on one of those buttons, hit submit, and we'll see what our audience's experience has been. All right, let's see what the results are. All right, well, it looks like a lucky group here. Not too many have been audited on their R&D credits or aren't claiming credits, so maybe you'll have audits to look forward to in the future after you have claimed the credits. But any comments on that, you guys?
Well, it's still, right around of those who are claiming credits, it's still probably 25% or something. So it's not a non-issue, but they're definitely we have about 40% of the people aren't even claiming a credit. So with 13% being who have been examined, I think it does show that it is still occurring, and I think you're going to keep seeing it be examined both at the state level as well as the IRS level. So.
And a lot of my clients still have their credits sitting as carry forward, so I'm sure it'll get a higher level of scrutiny once we start claiming those to reduce the taxes.
Yeah, John, that's a great point. I mean, the IRS is focusing on those when they start getting used, and when they start getting used, it's typically within a couple of years, especially if they're significant, that they will be reviewed. So as you're creating the filling up the cookie jar when you have net operating losses, it's great for those credits, but at some point when you start utilizing them, scrutiny definitely will be coming up.
Okay, well, let's take a look at companies who have been audited and have gone to court over it. And so for that, we're going to take a look at the recent court decisions and also some regulatory action in the R&D credit area. And we'll have Travis address that.
Yeah, and there's just so many court cases and regulations surrounding the R&D credit, and there's new ones coming out every year. I want to say there's probably over 40 court cases since 1981 addressing the R&D credit, and we've seen quite a few in the last five years or so. So I wanted to pull out some really good examples that were on point with the technology industry and could apply to a lot of the listeners that are on the phone today. So the first case that we're going to talk about is the Suitor case. And this is very recent. This was a case that was decided and published in October, so just a couple months ago. So the case involved a telecom company that claimed R&D credits on new telephone systems that it developed throughout the years. These telephone systems involved both hardware and software development. Now, the IRS, they really challenged these credits and tried to poke holes in a lot of different areas. But the case was taken to court, and the outcome of the case was actually pretty taxpayer-friendly. So I just want to highlight a couple of key areas that could apply to a lot of companies in the tech industry. So one of the first areas that the IRS picked on was whether or not the activity is qualified at all. The IRS's argument is that Suitor was really just performing routine engineering, and they were performing a lot of bug fixing, which doesn't really qualify. And so the court, they couldn't look at every project, but they chose a sampling of 12 projects and evaluated those projects against the 4-part test. And they determined that all but one of the projects qualified and met the requirements. The one project that didn't qualify here is called the Chameleon project. And what that was it was a user interface that gave users the ability to change colors, fonts, button shapes, button sizes. It didn't really change the functionality of the program itself. And so what the court said is that's not a qualified purpose. Those activities were just for look and feel. Also, the courts rejected this routine engineering argument that the IRS tries to make a lot of times. They said there's no such thing as routine engineering. If the activities meet the 4-part test, then it qualifies. So we were grateful to see that argument finally addressed in a court case. Also, the argument about bug fixing. What the courts determined is that bug fixing made up less than 20% of the development activities. Now, therefore, they met the substantially all rule. If 80% qualifies, then you claim 100%. And so they were able to include even the bug fixing activities. Now, the other area that they picked on was high wage earners and executive compensation. Now, the company, the CEO was Eric Suitor. He was the owner and the CEO of the company. And he was the one coming up with all of the new product ideas. He was heavily involved in new concepts, new product concepts, involved in a lot of the meetings with key executives on new product ideas. And the taxpayer, Suitor here, they included 75% of his wages towards the R&D credit. Now, he was also paying himself a very high wage. It was over $10 million a year. And so, after hearing a ton of testimony throughout the court case, courts determined that he was engaged in R&D. The 75% estimate was accurate. However, his wages were not reasonable for the work he was performing. So they knocked his wages down from $10 million to $2.5 million, and he got the credit on the $2.5 million. Now, just some highlights. What was the key to the success of this case? It was really about the documentation that the company retained and the testimony of the employees that worked there. So, oral testimony was really key in the case. The company's VP of operations was on the stand for 4 days testifying about R&D activities of the company's engineers and justifying the amount of time that each employee spent on R&D activities, including Mr. Suitor himself. The IRS even called 8 former employees to the stand, with the hopes that their testimony would contradict that of Suitor's current employees. And what the courts found is that the testimony of the former employees actually helped make the case that Suitor was engaged in R&D at least 75% of the time. So also here on the slide, just got a list of some of the different examples of documentation that the courts considered when they were evaluating the R&D credit claim. So bug reports, specifications, release notes, things like that were all acceptable forms of documentation. So just a few key takeaways from this case. Your day-to-day engineering activities could qualify. Just because it might be routine engineering to you, as long as those activities meet the 4-part test, they could qualify for the credit. Same with high-wage executives who are coming up with new ideas or providing input on new product concepts. As long as their time can be documented and corroborated by other employees, then that time could be included.
Well, this sounds like it's a great win for the taxpayer. One of the other takeaways would be nice to your former engineers, former employees. They may come back to testify someday.
So we're going to get into the next case here. This is also a very recent court case. Geosyntec was the name of the company. And so this case was really about funded research. I actually had a question come in here, and I thought I'd wait to address it until this section because it's really on point. Now, funded research, when a lot of companies hear that term, they're thinking of government grants, research grants, that type of thing. But that's not really the case for the R&D credit. Your company needs to look at the contracts that you have with customers and to see how the payment terms are structured. In this court case, they looked at 3 different types of contracts that are very common throughout all industries. The first was a fixed price agreement. So under the fixed price agreement, the taxpayer, Geosyntec, was not going to get paid unless they produced some kind of deliverable, reached certain milestones, or achieved specific results. So they had risk. They had financial risk, which is a requirement. You must have financial risk in order to claim the research credit. So the courts determined that the fixed price contracts were all qualified. The other type of contract was time and materials. Now these contracts did not qualify because Geosyntec had no risk. They put their time in, they submit the invoice to their customer, and they get paid for all that work. So there's no financial risk. It's not R&D credit eligible. The other contract was time and materials with a cap. Now this one was a little bit tricky. The courts determined that these types of contracts were funded. They said the Geosyntec didn't have enough risk, but it didn't really address what would happen if Geosyntec went over the cap and whether or not those R&D expenses would be eligible. That wasn't really addressed in the court case. And just because this court said time and materials with a cap didn't qualify, it's really something that is determined on a contract by contract basis. We really have to dig into the terms of the agreement, figure out where the risks are and how the payment terms work before we can make the determination on whether or not the research is funded. Okay, and then here's another regulation that came out recently regarding the alternative simplified credit. I think Tom mentioned the alternative simplified credit earlier. Before this regulation came out, you could not claim the ASC on an amended return. So this changes that. Taxpayers can now go back if they've never claimed the credit and claim the ASC on their amended returns. Now, the one catch here is that if you've already claimed the regular method, you can't go back and change it to the ASC. They want to prevent IRS audits on 2 different credits during the same year. So this 174 regulation, this applies to companies that are producing prototypes and pilot models. And the reason this is relevant is because in order to qualify under Section 41 for research credits, you also have to meet the requirements under Section 174. Now, before these regs came out, the IRS used to argue that prototypes and pilot models could not be included as a qualified supply because the research resulted in depreciable property, and property of a character subject to depreciation could not be included as an R&D expense. Well, this rule basically says that the final outcome doesn't really matter. As long as there was technical uncertainty as to whether the prototype or pilot model was going to be successful in the first place. So if you're building prototypes and pilot models that end up meeting your requirements, but they're ultimately sold to a customer, or maybe they're used in your business, that doesn't necessarily preclude you from claiming the R&D credit on all the expenses that went into developing those prototypes or pilot models.
Those prototypes can be expensive, so that should really enhance what people are looking at in terms of the supply component.
Yeah, they could be huge. There's a lot of dollars that companies spend on developing prototypes and pilot models. So the last recent development section here, this relates to an audit guide for the software industry that was published by the IRS back in 2005. It's basically a roadmap for IRS agents telling them how to audit R&D credits claimed by software companies. And, we don't necessarily agree with all the things they're saying here in this publication, but I think it's really helpful to understand some of the areas that may be a little, more heavily scrutinized, just so you're aware of where you may need to beef up your documentation. So again, regardless of what this says, if your activities are meeting the 4-part test, they're likely to be eligible for the R&D credit. But this guide here, which you're going to see on this in the next couple pages, is how the IRS views software development activities. They divide activities into 3 different categories. So you've got high risk, medium risk, and low risk categories. And we'll just share some of the examples that fall into each of those. So,
but Travis, the guide isn't law or even the rules per se. Is that fair to say?
That's true. When this was developed, it was developed by a company called MITRE, and it was a contractor the government uses to audit a lot of software developers. And the way they interpreted the rules is really under the old regulations, which included the discovery test, and didn't really address TD 9104 and some of the other preambles to the new regulations about qualified research. So it's a good comment. We'll just show you some examples here. Things like maintenance and bug fixing are going to fall into the high-risk category. Functional enhancements and improvements would fall into the medium-risk category. And then, anytime you're doing the initial release of a software application, those types of things fall into the low-risk category.
Okay, very good. Well, our last polling question. Development of internal use software may be credit eligible. And this is simply true or false. So click on one of those, hit submit. We'll see what people think about internal use software. Here we go. Okay. The majority of the people think that that's true, that internal use software may be eligible for the credit. Do we agree?
Yeah, I think we agree. As long as the activities meet the 4-part test and the additional 3 tests that Tom described earlier, then your internal use software activities could be credit eligible.
Great. And now to wrap things up, Tom, why don't you take us through what we can be doing now?
Great, yeah. So the big area, just as it's been mentioned a number of times, is just start documenting the potential projects, the products or the processes that may qualify. Get those into a mindset of let's capture information on those things. Even if you're not using the credit immediately, saving that information is going to be invaluable in the future. And it doesn't have to be, as mentioned, it can be very simple stuff like calendars and notes, and it doesn't have to be a formal R&D papers that we're keeping or documentation. It can be as simple as interviews with people or calendars, emails, things of that nature that talk about how we meet the 4-part test, the technical uncertainty that's out there, the experimentation that occurred. Things like that are going to be very, very valuable. And then also just the ability to isolate and track the expenses related to potential R&D activities in a manner that's going to work for your business system. In a lot of cases, it doesn't make sense to capture this stuff in a manner that's going to be not cost beneficial, or we're not going to do a good job at it. So try to be just smart on what areas we need to capture. If we're using contractors, make sure it's easy to figure out what projects those guys were working on. The individuals, if we can keep track of their time on a regular basis, whether that's monthly, quarterly, or something of that nature, that would be very good. And just create a culture of keeping the documentation and support. This stuff, the credits for federal purposes can go for 20 years. I mean, the usability can go for 20 years. And in fact, in one case, we did an R&D study where we covered 18 years. And, obviously the big challenge relates to the documentation that's available, turnover of personnel. So anything like that that we can help beef it up, the stronger our credit's going to be. And then, obviously consult professionals who understand R&D tax credit. Our group, that's all we do is the R&D tax credit. So we kind of understand the court cases, the legislation that's occurring, and things of that nature. But, the R&D credit is highly subjective and can be challenged by the state and the IRS. It's one where if you are claiming the credit and the IRS or state asks for more information, stop and consult for sure. We've seen large holes being created that we could have eliminated very quickly. How you respond to things, even if it seems like it's a very simple response, really does add value on supporting these credits. And we've seen some areas where the client said, hey, we tweaked this or we did that, and it just conveyed a message of not highly technical, highly uncertain, things of that nature. So really work on that. Ask for a provider to provide a free consultation and really customize what you're looking for, what you need to get the stuff documented, and to create a system that's going to really work well for you. And then pay attention to fees and terms. This is probably one of my bigger ones, just because I've seen some crazy issues with the pseudo contingent fees, which are basically you're paying them based on what they're filing versus what's usable or what's sustainable. And in some cases, I've seen it where hundreds of thousands of dollars of fees were going out the door, and there was no benefit for probably a decade. So, and the person's already signed a legal contract. So really understand this. Find a provider that really can help you and really wants to basically work with you to create a system that's really right for your company. Key takeaways, we've hit a lot of these areas, but, the credit is available for all industries, all companies. The tech and life science areas, it's a no-brainer. It becomes more of a usability issue. The rules are often subjective. The court cases, law changes very, very frequently. And, I think the last bullet point, have the first meeting with an R&D professional to make sure you're not missing out, and call with any questions. We get questions all the time, and in a lot of cases, that we can answer it very quickly. So we really encourage everybody to call us, ask us some questions, and if it warrants more work, that's one thing. But if we can just help out in some basics, that's fine as well. So those are kind of the big key takeaways.
Okay. Great, Tom. I think we have a minute for some questions. Tom, do you want to address any of the questions that have come in from the audience?
Sure. You guys may have access. Travis, why don't you pull one up?
So let's see here. We have a lot coming in here. So one I've got here, does the cost of using contract manufacturer to build prototypes qualify? That's a great question. They could be included as a qualified supply. Even if the prototypes are being manufactured overseas, like maybe you've got manufacturing in China, but the prototypes are being sent to your facility in the U.S. and you're testing them here. As long as the testing is being performed in the United States, then there's the potential to include those as a qualified supply expense.
So as mentioned, we got a ton of questions, and we'll commit to everybody who put a question out there. We'll get back to you to answer those, but I think we probably need to keep on moving. So the last one just relates to just some information. Before you go, as I mentioned, there is a LinkedIn group that we have a lot of information out there. Here's our contact information. If you have any questions, don't hesitate to call or email us. These are our practice leaders on the right-hand side of that. And then our website at mossadams.com has information on the R&D credit as well as lots of other incentives and services. So overall, we look forward to communicating more with everybody and answering any questions. I just scanning through the Q&A, there's a lot of great questions out there, and we look forward to getting back to people. And please do send out more questions if you need to. So.
Great. Thanks, Tom and Travis, and thank you all for attending the webcast. We hope you got a lot out of it.